Welcome to TalkTickers. We're your shortcut to getting, truly well informed about the market's big headlines and maybe those subtle shifts too. Today, we are taking deep dive into a Q2 2025 earnings call. It's from a major global industrial player. And this quarter, wow, they really faced a mixed bag. You've got demand all over the place, currencies doing unexpected things, but somehow they managed to, almost defy gravity in some key areas. Our mission today, to peel back the layers of this call, figure out what really happened, and get a clearer picture of what might be next for them. So let's get right into it. The headline numbers for Q2 2025. The immediate snapshot might actually surprise you. What's the big picture?
Yeah, the headlines, they tell a really interesting story. You look first and see nearly flat organic sales, just a tiny 0.2% decline year over year. But then absolute net sales dropped almost 10%. That's pretty significant. And it's mainly down to these massive native currency effects.
Okay, so top line pressure, definitely.
Definitely. But here's the twist. Despite all that, the company didn't just, hold the line. They actually improved their adjusted operating margin. It went from 13% last year to 13.3% this quarter.
Wow.
And on top of that, net cash flow was notably strong and improved quite a bit, from 2.2 billion Swedish krona last year up to 2.8 billion this quarter. So the real insight here is, how did they manage to boost margins and cash flow when the top line looks so challenging? It points to some serious underlying discipline.
That really is quite a tightrope walk, isn't it? Revenue's taking a hit, but margins and cash actually getting better. It genuinely makes you wonder how they pulled that off. It almost sounds like, two different companies operating under one roof. Let's try and unpack that a bit more. This tale of two segments idea, especially when you look across different regions.
Exactly. It really is a tale of two distinct businesses right now. The industrial segment, it truly shown this quarter. Positive organic growth of 2.4%.
Okay, 2.4% for industrial.
Yeah, and this isn't some small side business either. Industrial now makes up a huge 72% of their total sales.
72%.
And an even more dominant 89% of the adjusted operating profit. Its own margin is sitting at a really robust 16.6%, which is up from 16.3% last year.
Impressive.
And what's really impressive is that this growth, it wasn't just in one spot, it was across all regions for the industrial business. They saw specific strength in areas like lubrication, aerospace, and magnetics. Now, conversely, you have the automotive business. It makes up the other 28% of sales and just 11% of the operating profit. It saw a pretty significant organic decline, down 6.2%.
Oof. Yeah.
And that was really driven by, continued low demand, lots of volatility, particularly noticeable in Europe and the Americas for both light vehicles and commercial ones. But even with those really low volumes and the negative FX impact, its adjusted operating margin held up okay, just over 5%, which honestly, given the circumstances, is considered, pretty decent.
Okay, so 5% margin in automotive versus over 16 in industrial.
Exactly. So you've got this thriving industrial core, which is effectively carrying the weight of a much more challenged automotive side.
That stark contrast, industrial thriving while automotive struggles, it really jumps out.
Mm-hmm.
But the baffling part, like you said, is how they're improving the overall group margin despite those, brutal automotive headwinds and the big currency hits. It seems almost counterintuitive. Is there one secret sauce here? Or is it a mix of things?
It's definitely a combination, and I think it speaks volumes about their resilience right now. Management, they highlighted several key initiatives, things they've been working on diligently that are clearly paying off. They mentioned strong pricing discipline right across the board. Active portfolio management, basically, focusing their efforts on the most profitable areas.
Smart.
And robust cost control. Plus, they're clearly seeing the benefits now from earlier investments they made in automation within their manufacturing footprint. That makes their operations more efficient.
Right. Those longer-term bets paying off.
Exactly. And they specifically noted they were able to largely compensate for recent tariff increases through shrewd price adjustments and surcharges. That helped mitigate the hit on the overall margin.
Okay, so passing those costs through effectively.
Seems like it, yeah. And even on the automotive side, despite the volume challenges, they emphasize they're continuously working with suppliers, intelligently finding more cost-effective material mixes just to uphold margins in what's still a very tough environment. So yeah, it's a multi-pronged approach, not just one thing.
So it's not just about cutting costs then, but also that smart pricing, the portfolio work, even automation benefits. That is a powerful combination. It really sounds like they're playing, financial chess, not checkers, especially with those tariff adjustments. Now, while those short-term wins are impressive, it's really the long game that defines a company's future, isn't it? And it seems this management team isn't shying away from some big structural bets.
Let's pivot now to those really significant strategic programs they talked about, the ones designed to strengthen the business long term. I'm thinking about the industrial right-sizing program and that ongoing complex automotive separation.
Indeed. And that really gets to the heart of, how are they building for the future? So the right sizing program, it was first announced last quarter, Q1, but now we have much more concrete details. It involves a gross reduction of about 1,700 staff positions.
Okay.
However, after you factor in some rehires, mainly due to their ongoing regionalization efforts, the net impact on full-time equivalents, or FTEs, will be around 1,200 positions.
So a net reduction of 1,200. Correct. And this program, it's anticipated to generate really significant annual savings. We're talking 2 billion Swedish krona per year. That's expected to reach its full run rate by 2027. They mentioned a sort of linear profile in 2026 and 2027, meaning the savings will ramp up steadily over those 2 years until they hit the full 2 billion annual impact.
2 billion SEK a year, that's substantial.
It is. And crucially, they expect these savings to more than offset any potential dyssynergies.
The synergies, right. The extra costs you sometimes get when splitting up.
Exactly, like needing duplicate systems or services for a while. So the savings should cover that, and then some. Now, the restructuring charge for this program, that's about 2 billion SEK too, roughly matching the annual savings target. That charge was fully recognized in Q2 as an item affecting comparability.
Meaning it's a one-off hit, basically.
Yeah, it's a significant one-off cost. It hits the books now, but it doesn't reflect their sort of ongoing operational performance long term. Important to note, though, the cash impact of that charge won't really be felt until 2026, mostly.
Okay, got it. So the accounting hit is now, the cash out is mostly later, and the savings come steadily over the next few years. What about the automotive separation itself? I remember last quarter there were mentions of, critical milestones, even some risks of delays. Where do things stand now? Are they really out of the woods, or is there still a rough road ahead?
Yeah, not out of the woods yet was the exact phrase management used. The separation is definitely building momentum, but they were clear there are still critical milestones they need to pass this fall, particularly things like government and authority approvals, which are, somewhat outside their direct control.
Right, external factors.
Exactly, and the whole process involves a very tight schedule. There isn't much headroom for delays. However, the good news, as of the earnings call at least, was that no red flags had popped up. None of those potential risks had actually materialized yet. It's also worth remembering this is quite different from the industrial right-sizing. Here, the automotive team is essentially building a brand new, lean, standalone business almost from the ground up. It's like a startup within a spinoff.
That sounds like a huge undertaking, building a whole new structure. Speaking of building for the future, they also made a point of highlighting their aerospace business, calling it out as a prime example of commercial excellence within their industrial strategy. What can we learn from that specific vertical? How's it contributing to their broader plan? It sounds like they see it as a kind of blueprint.
It absolutely seems to be the blueprint. Aerospace is a key industrial vertical for them already, makes up about 9% of their industrial sales. And following a strategic review they did a few years back, they made some really decisive moves. They doubled down, focused on core segments like engine bearings, aerostructure bearings, and importantly, they divested non-strategic assets like the handover business they sold off.
Right, portfolio management in action.
Exactly. And that sale actually generated a tidy profit, about 800 million SEK, which helped offset some other charges. But beyond that, they significantly ramped up their aftermarket presence in aerospace. They secured long-term customer contracts stretching out beyond 2030. And crucially, they doubled their investment pace in aerospace, pouring money into productivity, automation, building capacity to meet the really strong demand they're seeing there.
Yeah, and the results.
The results are, frankly, quite impressive. They've achieved a 12% compound annual growth rate, CAGR, in net sales for aerospace between 2022 and 2025. And maybe even more impressively, an 8 percentage point improvement in its adjusted operating margin over that same period.
Wow, 8 points of margin expansion.
Yeah. So aerospace isn't just a strong segment performing well, it's the proof of concept. It shows their whole commercial excellence strategy can deliver really tangible results. And the plan explicitly is to replicate those capabilities, that approach, across their other industrial verticals. So it's a critical leading indicator for the broader company's future, I think.
That really is a powerful proof point. Okay, let's look ahead then. Thinking about Q3, what's the company's guidance? What are the main factors shaping that outlook? It feels like there are still a lot of moving parts right now. especially with these big strategic shifts underway.
You're right, lots of moving parts. For Q3 specifically, they expect organic sales to be relatively unchanged year over year, so flat, basically.
Flat organic growth for Q3.
Yes, they also anticipate a similar negative FX impact as they saw in Q2. That's around minus 500 million SEK, based on the exchange rates at the end of June. Guidance for things like tax rate and capital expenditure, those remain unchanged from previous forecasts.
And the tariffs, are they still expecting to offset those?
Yeah, when they were pressed on that during the Q&A, management reiterated their aim is still to largely compensate for tariffs in Q3, mainly through pricing and surcharges. They did note, however, that the net impact of tariffs would probably be most visible within the automotive segment, given its, weaker underlying performance.
Right.
But they also flagged something else, potential negative mix dynamics going forward.
Mixed dynamics. What does that mean in this context?
Well, basically, their pruning activities where they were actively getting rid of less profitable business or cutting back on lower margin sales, those activities had been helping boost the overall margin mix. Now, those pruning efforts are largely concluding. At the same time, the sales decline they were seeing in OEM and distribution channels is starting to equalize. So the net effect could be a slightly less favorable sales mix impacting margins as they move forward.
Ah, okay. So the boost from pruning might fade, potentially creating a bit of a headwind on mix. Makes sense.
Exactly. So the picture for Q3 and beyond is still complex. You've got these internal improvements and strategic actions battling against those external headwinds like FX and maybe some mix shifts.
Right. Inventory levels and regionalization also came up in the Q&A, didn't they? Is the company making, discernible progress there, especially with all these efforts underway? And how much does the overall demand environment factor into that?
They did confirm there's a high internal focus on reducing inventory, and they are seeing a positive trend, especially if you strip out the distorting effects of FX. Their world-class manufacturing program is apparently helping quite a bit with that. And the regionalization efforts, they're ongoing and starting to show tangible year-over-year effects as supply chains become, hopefully more agile.
So progress is being made internally.
Yes, definitely. But they were also realistic. They acknowledged that a stronger overall demand environment would significantly accelerate the improvements they expect in inventory turns. So while they're doing their part internally, pulling the levers they can control, the macro demand picture still plays a really big role in how quickly those inventory gains materialize. They're positioning themselves well, but they need demand to pick up too.
Okay, that makes sense. Finally, let's just circle back quickly to the costs. Beyond that big 2 billion SEK industrial right-sizing charge we discussed, what's the expectation for other items affecting comparability, those other one-off type costs, especially the separation costs for automotive and the timing of when the cash actually goes out the door?
Right. So the separation costs related to splitting off the automotive business, those were about 300 million SEK in Q2. Interestingly, they expect those costs to actually increase in Q3 and Q4.
Increase. Why is that?
Because the momentum for the actual spin-off is building. More activity means more cost in the short term, things like setting up independent systems, legal fees, advisory fees, that sort of thing.
Gotcha. More activity, more cost near term.
Precisely. Additionally, those regionalization costs we mentioned earlier, they were pretty minor in Q2, apparently just due to timing. Those are also expected to be pushed more into the second half of the year. So putting it all together, the company explicitly stated that these items affecting comparability, the separation costs, the regionalization costs, maybe some trailing restructuring bits, they're expected to remain fairly sizable right through the second half of this year.
Okay, so more noise in the reported numbers for a couple more quarters.
Likely, yes. And regarding the cash impact of that 2 billion SEK right-sizing program charge, they reiterated that the vast majority of the actual cash outflow is expected in 2026. Very little significant impact on this year's cash flow from that specific program. Oh, and one other useful clarification they made, linking back to pricing. They pointed out that surcharges, which they're using to offset tariffs, are generally less sticky than permanent list price increases.
Less sticky. Meaning easier to remove.
Exactly.
Yeah.
Surcharges can fluctuate or even disappear if tariffs change or other input costs go down. A list price increase tends to be more permanent. It's a subtle but important distinction when you think about their long-term pricing power.
Good point. Okay.
Yeah.
And now let's transition to our popular segment. This is not financial advice.
Okay.
And as always, we have to stress, this is purely for entertainment. It's for thought-provoking discussion. It is definitely not a recommendation for your portfolio or anything you should actually act on financially. Please remember that. So with that very important disclaimer firmly in place, what's an outrageous but plausible trade idea that emerges from digging into this particular earnings call?
Okay, well, given the really strong narrative we've discussed around the industrial business, its margin resilience, its strategic focus, that big right-sizing program designed to build long-term competitiveness. And contrasting that with the, stated challenges and the much lower margins in the automotive business, here's a thought. Consider a kind of pure play pivot strategy.
A pure play pivot.
Okay, think of it like this. You're betting on the strong horse and maybe hedging against the one that's still finding its feet, but only once they're running on separate tracks. So the outrageous but plausible play would be this. Once the automotive separation is fully complete and you have two distinct publicly traded companies, you could establish a long position in the newly independent, streamlined industrial company.
Okay, long the industrial pure play.
Simultaneously, you could potentially take a short position in the spun-off automotive entity.
Short the new automotive company.
Yeah.
Interesting.
Yeah. I mean, the rationale for this trade, outrageous as it might be, is you'd be betting on that industrial business accelerating its profitable growth trajectory, benefiting from its clearer focus, the cost savings kicking in, while at the same time, you're hedging against the, let's face it, inherent volatility and the lower margin profile we see in the automotive sector right now, especially as that new standalone automotive company navigates the challenges of its operational build-out.
So betting on divergence, basically.
Exactly. It's a speculative bet on the divergence of two increasingly distinct business models and market perceptions once the market finally gets a clear, unclouded look at each one individually. Purely hypothetical, of course.
Of course. An interesting thought experiment, though. Okay, that wraps up our deep dive into this Q2 2025 earnings call. We've definitely covered a lot of ground. A quarter showing mixed demand for sure, but also some real underlying resilience, driven by strategic cost controls, that pricing discipline, and these significant long-term structural changes, the right sizing, the automotive separation.
Yeah, it's clear the company is working diligently here. They're trying to build a more competitive platform, aiming for future profitable growth, even while they navigate all this current market uncertainty and the sheer complexity of divesting such a significant segment. Definitely keep a very close eye on those critical milestones for the automotive separation this fall. That's key. And of course, watch for those full run rate savings from the right sizing program as they start to materialize through 2026 and 2027. It's going to be fascinating, I think, to see how the market eventually values these two pure play entities once they're separate.
Absolutely. Well, thank you for joining us on TalkTickers today. We really hope this deep dive gave you some valuable insights into how a company can manage to navigate pretty significant headwinds through focused strategic action. Until next time, stay well informed, and please remember, this discussion is purely for informational purposes. It is not and should never be taken as financial advice.